whoever replaces them is going to lean towards rate cuts, which has the potential of weakening the dollar. And we'll have to watch how the long end of the yield curve responds to that, because long end investors in the bond market don't want inflation. They don't want easy money.
Welcome to Rise Up. We're excited to spend some time with you here today, reviewing the last week reports and helping you think through portfolio decisions. I know there's been a lot of volatility, a lot of change, but we have our experts here in the RIA wealth management space that are going to help us think through how to grow and protect our portfolio. And that's really our mission here at Rise Up, is to give you ideas and thoughts on your portfolio. So my name is Terri Kallsen. I'm a certified financial planner. I'm a partner here at Rise Growth, and I'm the co-host of our show. Joe Duran, our other co-host, is not able to be with us here today, but he sends his best wishes, especially as we move into a holiday week next week. But I do have two experts with me that have been on the show multiple times, and I know you know them, and I know you trust their advice. First of all, we have Andy Schwartz, who's with us, who's a CFP. He is the CEO of Bleakley Financial Group, and he has been an expert in helping clients think through their financial plan as well as their portfolio decisions. We also have Peter Boockvar, who is also the CIO at Bleakley Financial Group, and he also writes a tremendous resource called the Boockvar Report on Substack. Hey guys, it's great to be with you here today. I mean, we actually have some good news to share today. The S&P is up, reaching incredible highs. It's bringing it to a gain of 2.9%, putting it just a few points away from our intraday all-time high, which was hit in late February. And so this is good news. The NASDAQ also advanced 1%, itself inches away from a new record, and the Dow Jones Industrial Average climbed about 0.9%. So right today, things are looking good. We've had several days together that this has not been the case. But there's been a lot of economic decisions. We've got, Jerome Powell talking about interest rate cuts. We've got the president, thinking about substitutes for Jerome Powell. There's been a lot going on. So I just wanted to get your take, Peter. I know you watch the markets very closely. Can you tell us what you're thinking right now?
Well, it's an interesting dynamic because this last leg over the past, call it 3 days, really followed sort of the end of the. I don't know if it's a war between Israel and Iran, but we'll call it what it is, more of a skirmish, but an end to whatever conflict that they had. So you had oil prices which rose from about mid 60s up to mid 70s when it started, and right back to the mid 60s. Also of note, the AI tech trade is sort of getting a second wind here. So NVIDIA has gone to new highs. Microsoft has gone to new highs, along with some other names in sort of that ecosystem. And then the third thing is, while there really wasn't that much of a change in terms of what the bond market's been pricing in, the bond market is leaning more towards the Fed cutting interest rates maybe 3 times this year instead of 2. We had 2 notable Fed governors, in contrast to Jay Powell, who was very non-committal at the Fed meeting a week ago, and also in his testimony this week in front of the House and Senate. We had 2 Fed governors, one Chris Waller, another one Michelle Bowman, that said they would even cut rates in July. So that got the market excited. Even though, it's unlikely to happen, the Fed's likely to wait till September. It did bring forward in the market's eyes that hey, we have rate cuts out there that can help us even if the economy slows, because the economic data has been extraordinarily mixed. So I can't say that we're rallying on a great economic recovery. It's more of the other things that I mentioned.
Yeah, exactly. There's no conclusion here, but as you know, the stock market fluctuates daily, but over long periods of time, it tends to reward those patient investors. And Andy, I know you work with investors every day. I know you encourage them to be patient. What are you telling your clients right now?
Yeah, I mean, it's a good point. We like to think of ourselves as investors, not traders. Obviously, allocations, the amount of equities we own, has to be somewhat correlated to what our liquidity needs are, what our time horizons are. But for true investors, one thing we try not to do is time a market. As you said, that we know over the long term, the market typically goes up, and particularly if we've got diversified assets. Today, the market's at all-time highs, but there are assets today that are not necessarily all-time highs. So there are certain sectors, whether it's some non-U.S. equities, whether it's healthcare, that really are not trading at record high levels and might actually be reasonable entry points for clients to get into the market. But again, I think that two things are really important: is make sure that your allocation, particularly the amount of equities you own, matches, the plan, matches your liquidity strategy and your time horizon. And I think that's really important. As long as you don't need the liquidity, don't try to time the market. And again, I can't tell you, should the S&P be trading at 23 times? It seems a little high to us, but the economy seems pretty good. The market certainly seems very, very excited and not concerned about, things like upcoming tariffs or Ukraine and Russia anymore, or anything else for that matter. So we'll have to see how this plays out.
Yeah, Andy, one of the things I love about what you said is this concept of recency bias. It was only last week on Wealthion, on our Rise Up show, we were talking about stagflation. And now, markets are almost at all-time highs. And so some of our consumers, our viewers, they tend to believe what's happening now will continue, but that may not be the case, as we know. And so, Peter, what are your thoughts on impending recession, even stagflation?
Well, I think on the inflation side of the potential stag, a lot will come down to the impact of tariffs. Now, theoretically, I agree with the concept that tariffs are a one-time step up in price. Therefore, because it's not repeatable, it's technically not sustainable inflation. Now, that said, blanket tariffs on the world does disrupt supply chains that could take multiple years to adjust to. And that is where the inflationary aspect can come about. Now, if you're in the construction space that needs to procure steel or aluminum or lumber, then you may feel a multi-year sort of experience of higher inflation. On the growth side, growth is still pretty mixed. The economy is really being boosted by upper income spending, robust AI spend and any of the beneficiaries there, and still large amounts of government spending that's flowing into the economy. But the rest of the economy is rather mixed in housing, lower to middle income spending, global trade, manufacturing, capital spending. So it's very uneven, the economy. But we're watching all the things that are out there, and really in the second half of the year, how tariffs, assuming a 10% sort of global rate, newly 10%. We came in this year with about 2.5% tariff rate. That'll go up to about 12 to 13. And we'll get to see when we read second quarter earnings results what the flow through is of that and what potential economic impact it could have. And finally, on the labor market, we're beginning to see some moderation in the pace of job hirings and a little lift in firings. And we'll have to see whether that is sort of tariff related in terms of causing uncertainty and a pause on business decision making. So it's just in time for second quarter earnings in a couple weeks, and we'll take that in to digest and hopefully answer these questions.
Exactly. And, one of the things I want to ask our viewers to do is if you're wondering right now what changes you might need to make to your portfolio, I'd highly recommend you go on wealthion.com for a free portfolio review. You'll get people like Andy, like Peter to help you assess your portfolio so you can make sure you're growing and protecting it. We'll move on now to our second big story, which is the Fed Chairman Jerome Powell testimony to the House Finance Committee. He made it clear he feels it's still too soon to be starting to cut interest rates. And, this is a pivotal point today. And Peter, I'm wondering, what are your thoughts on potential interest rate cuts this year?
So it really was a very interesting week. And when I say week, I mean starting last Wednesday when the Fed announced no change in policy. And in the press conference that followed, Jay Powell was very non-committal. He really wanted to be patient in terms of absorbing incoming data over the next couple of months. And that implied no rate cut in July. And if there was going to be one, maybe waiting till September. And then 2 days later on Friday, you had Chris Waller, who was a governor. So that is technically one step up from a regional president, who said, yeah, I'm all ready to cut rates in this July. And then on Monday, Michelle Bowman, another governor, hey, you know what? I can cut rates on Monday. So it was this kind of very interesting sort of divergence between the Fed chair and two of his sort of confidant colleagues. And now, on one hand, you can think that, okay, well, Chris Waller, all he's doing is politicking for Jay Powell's job come May, and the one that's going to sort of win that job is the one who's most dovish, and he's trying to be dovish. But then the rest of the week was followed up by Powell, to what you just mentioned, his testimony in front of the House and Senate, where he repeated his sort of desire, if they're going to cut, to do it in the back half of the year rather than July. And also some Fed presidents also didn't seem to be interested in cutting in July and in the fall. So there's this interesting sort of divergence within the Fed that that really was revealed over this past week.
Yeah, exactly. And, so many consumers think about, well, if they cut interest rates, the markets may go up, right? We think about that. But we also know the flip side of that, Andy, and this is where I know you're making a big difference in your clients' lives. When we cut interest rates, that means high yield savings accounts, interest rates paid goes down, and that has an impact on our viewers' savings. So what are you telling your clients now in the wealth management space about the potential rate cut?
Well, so I mean, I think a couple of things are really interesting. Is one is that rate cuts on the short end most likely will happen. Although from a market standpoint, we have to believe that that's been built in and anticipated. So we're not really sure how much boost the market's going to get. At the same time, we talk to clients about being careful when you think about duration on bonds, because just because the Fed cuts rates, which they probably will, maybe once or twice this year, the longer end of the curve might not go down. It might actually even go up. And so, we still think that there is some, duration risk. But I think that people have to be more thoughtful, because it is going to get a little bit harder to create yield. So I think some clients will probably be tempted to take more credit risk. And I think that at times that can be okay. Private credit could be a solution to get higher yields. But I think if you're looking for higher yield, I think it's really important for clients, if you're not working with a professional, make sure you understand the risk, because there is no free lunch. And when rates were at 4.5% on short-term treasuries, as they had been over the last 6 months, now we're a little bit lower. It's been pretty easy to take that rate. As rates go down, perhaps into the threes, and as people start to reach for more yield, they just have to make sure that they assess the risk that's coming along with that additional yield.
Yeah, that's so great. That's really our mission here at Rise Up, is not just growing your portfolio, but protecting your portfolio. And Andy has pointed out, I think, a real risk that if you don't have a wealth manager or a CFP in your life, you want to have that fiduciary helping, coaching you through these ever changes in our market today. Let's go on now to our third big story, and this is all about AI. And, there's been a big win for AI in court, which means it's a big win for investors that have invested in AI. A US judge ruled today that the company Anthropic, which owns AI tool Claude, did not break copyright rules by using authors' materials to build its language learning models. And so this is a big decision, and it really has a big impact on AI and the future of it. And so, Peter, you've been watching AI along the way, and the Mag 7, and in fact, NVIDIA hit a record high this week. How important is it us for ruling around and making recommendations around AI companies?
Well, it was an interesting ruling in the sense that the judge said that as long as Anthropic physically buys the books at which they are gleaning information into their model, then it's okay. They can do that. But if they're pirating it in the sense of they're not they're getting information from all these publications that they're not buying, well, then that crosses the line. So it wasn't necessarily clear cut from that perspective, but it did at least clarify the difference between purchasing the publications, the content versus not. But to your point, this is a big deal in the sense of we know what large language models are doing. They're grabbing all the information that's out there that other people have created, and whether that is the Wall Street Journal and New York Times, or whether it's a news network, or it's an author, or it's a magazine, or whoever created the content. How is these models? How are these companies going to pay for the content that they're bringing into the model? So maybe this was one step to some form of clarity, but I do expect we're going to need more in order to figure this all out. This sort of new economy that's being created by these models that are grabbing all this information that other people are creating.
Yeah, that's right. And, we start to think about the Mag 7 and concentration risk overall, and NVIDIA being a big part of that. You know, Andy, we've talked a lot about self-directed investors and have their portfolios heavily invested in the Mag 7. You've always told us about balance in a portfolio. Does this court decision start to change your philosophy on an upside of having a larger portion of your portfolio dedicated to AI?
Look, AI is real. It's going to change the way we live, the way we work. Um, it's going to be, maybe I was listening to a news story this morning talking about Amazon. I think just set aside $1 billion because they have what do they have? 800,000 warehouse employees.
I thought that was for Jeff Bezos' wedding. I thought that was for Jeff Bezos' wedding in Venice this week. Sorry. Oh, I must
No,
have
no,
read the wrong
that was
headline.
only Yeah, that was only 400 million.
Oh,
But they
okay.
set aside that billion to help retrain, because they think that potentially, 800,000 employees are at risk of losing jobs. So the reality is that it is going to have a tremendous impact. It's going to change everything, and there's going to be really good opportunity. The question is going to be, is that there's been so much gain in so many of these stocks already, and the question is, particularly with the Mag 7, is there will be winners and losers, because some of the Mag 7 will probably benefit and grow even more, and some of them, this might be a problem for. So again, we have to own them. If you own the S&P 500, if you own the Russell 3000, you're already very, very invested in these, companies. And so the question is do I own these companies in my regular allocations and portfolios, and then do I own them separately? Or if I'm not aware, just be aware that 30% or so of the S&P are those names. And again, I'm sure some of them are going to continue to be the darlings of the market, but some of them are not. We talk about this all the time here. When you've got an NVIDIA, for example, which is an amazing company, and they're making amazing profits and their margins are off the charts. But all of their biggest customers are also creating their own chips, and ultimately, that could be a problem. And when you're at a 70% or whatever their margins are today, but they're really, really high, as there's more and more competition in the market, those margins will come down. And a lot of the people that they used to sell to will not only not be behind their chips, but actually might be competing against them. Same issue, I was listening to somebody talking about Alphabet this morning, and the Google search, and they think it's the greatest, and it's all. And then the person asked, well, what about competition? What about people getting information from other sources? Isn't that an issue? And I think it could be. And so again, I'm not, no one knows for sure what the outcome is going to be, but I do think that it's all the more reason. And we can't avoid the space. We're all going to be invested in AI if we're in the market, especially if we buy indexes. So the question really is making sure that we aren't overly concentrated. Because I don't think it's a sure thing for all those companies. There's going to be a lot of companies that will look back 5 years from now who will benefit dramatically from AI, but it's not going to be these hyperscalers or the Mag 7. It's going to be lots of other companies that can really improve their businesses and their margins using AI. But I would just say we still want to be diversified. We're not going to own all of our assets are not going to be in 7 stocks.
Yeah, that's a great way to say it. And I think too, NVIDIA's pricing power, is it really sustainable? As you said, Andy, all these competitors are coming in. We even saw it earlier this year. So just keep it in mind, it's a darling today, but it may not be a darling a year from now. And see that balance in your portfolio should resolve some of that. So those were our big stories. Now let's move on to our big topics in terms of questions from our viewers today. And so first of all, there's been a real debate among self-directed investors and then those who have a wealth manager who's either a CFA or a CFP. And, how do you manage your portfolio best? Is it with guidance and help from someone by paying a fee, or is it best just to go it alone? And, Andy and Peter and myself have decades of experience as CFPs, CFAs, helping clients think through. So we have our first question from William in Minneapolis. And William says that he read that self-directed investing in index funds outperforms wealth managers or portfolio managers when you consider fees, and after taxes. And if that is the case, why should William hire a wealth manager to help him think through this? Andy, what are your thoughts?
Yeah, it's well, first of all, I think it's really important to create a distinction or understand the distinction between a portfolio manager and a wealth advisor because they're two different roles. A portfolio manager is the person that manages that actual investment. So then the question is, if I'm a portfolio manager and like for example, Peter Boockvar is a portfolio manager. So if Peter's a portfolio manager and he's a macro manager, the index would be the global macro index. So Peter might or might not outperform. Peter does outperform, but not all managers will. The distinction though is if you have a advisor, the advisor can make a decision whether they own indexes or whether they own managed assets. At Bleakley, we tend to own both. And I'll give you an example. We like to index domestic equities because the US market is very efficient, but we do it with a little bit of a bias or a little bit of a twist. We like to own separately managed accounts for the Russell 3000, meaning that we own the stocks in the Russell. It is indexed, so it's cheap, but we have a tax loss harvesting strategy built in so that the market's up or Russell's up like 5% year to date, which is great. So if I'm in a Russell index, I'm up 5%. If I'm in a separately managed account, I'm still up 5%, but I have stocks inside that portfolio that I've been able to tax loss harvest so we create losses for our clients. So when we talk about, indexes, we like to be thinking separately managed accounts. On the international side, we tend to think that we don't necessarily want to own the entire markets. And there are some international managers. We run a healthcare portfolio where our managers outperformed the market over the last 4 years by, say, his index by 500 basis points or more. I would argue that I'd rather pay 30 basis points more in a fee to outperform by 500 basis points. So the other thought is that all managers are not equal. But the idea of the wealth manager, there are so many times. I was on a call today, a client, I'm working with the client and her son. And there's a position, excuse me, that the son has that is very, very highly appreciated, really highly appreciated. Mom's a little bit older. And so the idea is we're going to transfer, which we can do, a like kind exchange between mom and son in their trust. Because what will happen is when mom dies, that giant gain will disappear because there'll be a step up in basis. So the idea is the son's got a $700,000 gain in that portfolio, which obviously we don't want to sell and we don't want to pay the tax. We shift that over to mom who doesn't need the money. And then ultimately when she passes, those taxes disappear. So I figured we'll probably save the client a couple $100,000 in taxes. And then I might ask, is that worth the 1% advisory fee? And there's 10 examples a day of those kind of situations, whether it's income tax strategy, whether it's estate planning strategy, whether it's just making sure that assets are allocated properly, whether we have proper liquidity plans, retirement analysis are done. So I would say, one, understand the difference between a portfolio manager and a wealth manager, and you can own index funds and be with a wealth manager. So anyway, hopefully that gives you some insight.
Well, I think that's an excellent example of how you really started to understand what the mother and the son's goals are, what their unique situation is, what their tax situation was, and what their timeline is. And that's what wealth managers, CFPs do. They take out the cookie cutter approach to investments and they really understand the situation. And you've just saved that client thousands and thousands of dollars because of your fiduciary responsibility, meaning you always have to act in the best interest of your clients. And so, what a gift you've given that client family. So, let's go on to our next question. And this is from Janice in Chicago. She says she's been successfully self-directed investing for years, but now she's going through a divorce, and we all know that have a significant impact on people's financial situation, both the spouses and any children or beneficiaries. And so she has all her investments, her portfolio, her home, her life insurance, and her 401k now is at risk because of the divorce. Can you just talk about, Andy, how I know you've seen these types of clients, you've helped them. What are some of the suggestions you might have for Janice in Chicago?
Just a simple one, but I don't think people think about enough, is that all assets are not equal, meaning that a qualified asset, for example, is going to be taxed ultimately. A non-qualified asset isn't. If assets have low basis or big capital gains, that asset isn't equal to an asset that has lower capital gains. So you want to be very, very careful that you're analyzing all of the assets, whether they're qualified or non-qualified. And what the ownership is. So as you help your clients sort of, divide up assets. So I think that's really, really important. And also try to take some of the emotion out, because divorce is a very emotional, I don't even want to use the word exercise, because it's really more of like a traumatic, experience, for everyone. And so I think having a professional that can be calm, and sort of not emotional about helping people make decisions, is really, really important. We help clients all the time. Oftentimes, we kind of pride ourselves that we will typically keep both clients. We have a couple, they get divorced, and we typically keep the husband and wife because, one, we don't want to take sides, but what we really try to do is encourage people to try to go through that process, as civilly as possible, because in the end, when it's over, especially if there's children involved, you want to be in a situation, where everybody, can actually put it all back together eventually, and that's really, really important. So we really try to counsel our clients. We have a life coach on staff who spends a fair amount of time in those conversations, because divorce is a traumatic experience, and trying to explain the benefit of trying to do that exercise, going through that process in a civil and reasonable way. And it's not about winning, because nobody really wins, but it's about how do we go forward, going forward, and actually try to live a happy life for them, for the other spouse, and for their children.
Yeah, it can be a real win-win-win. And as a CFP, you're thinking through all the implications, not just the investments, but their entire financial goals and their financial plan. And that's really the value of a CFP, really thinking beyond just the pure performance of a stock portfolio, which is important, but it's only one component. So let's go to our last question. And this is from Robert in Rhode Island. He could definitely use some advice in thinking about his portfolio. And he has certain life goals. He wants to achieve them, but he doesn't know really how to get started for this. And he's wondering if he should hire a fiduciary, a wealth manager. And I'm a CFP myself. I'm the chair of the CFP board. Next year, I work with hundreds of thousands of CFPs across the country. So just recognize that I'm a big advocate for having a holistic financial planning experience. But Robert in Rhode Island, what I can say is if you really want to achieve your financial goals in a holistic way, if you want to think about your tax plan, your estate plan, insurance needs that you have, and risk management, what we call insurance is really about managing your risks. And if you manage your risks around mortality, morbidity, and even liability, you can then achieve your financial goals, your cash flow, and any budgeting you need. And then understanding withdrawal strategies. If and when you're ready to retire, there are timing aspects of withdrawing from your portfolio based on taxes. So these are very important considerations in hiring a wealth manager. Now, Andy mentioned a life coach. And when we think about life coaching as a wealth manager, this is really about coaching behaviors. And it's just like, I know Andy and Peter both work out pretty vigorously, and they have a coach, they have an exercise coach that helps them with nutrition and exercise and living the life for the outcomes that they want. And that's exactly the same thing that a CFP does. They make decisions, they make guidance, they help and coach versus on data and your goals versus just pure emotional decisions. And so having a life coach or a CFP can help protect you from any self-sabotaging behaviors that will help you stick to your financial plan so that ultimately you achieve your goals, Robert, in a way that's patient, calm, and understanding. But most important is customized to you. And they can use AI, they can use various financial planning tools, estate planning topics, but they can bring all of those resources to you to make recommendations and be with you for the next 10, 20, 30 years, which I know Andy and Peter have done to assure when you retire that you're happy and your estate plan is set, as well as any type of beneficiary changes that you need to make at any time in your life. And so it really helps you save time, effort, and gives you peace of mind. So Andy, Peter, anything you want to add to that?
What I would say is I think part of the question was like, how do you know? How do you pick? The most important thing to me is if you're talking to a wealth advisor, if you're interviewing, which is what you're doing, make sure that that wealth advisor is listening to you. You don't want to have a wealth advisor that is talking at you. You want to have a wealth advisor that is listening to you. And that means that when they're talking, they should be asking questions, not making statements. Because the most important thing in an initial consult, with a potential client or someone that's looking for help, is that we understand as much as possible about them, what their needs are, what they're trying to accomplish, because that's really what the meeting is about, and that's really what the job is about. And so I would basically be looking for someone that is asking me relevant questions, listening to me, understanding me, and not necessarily talking about themselves or how awesome they are. That would be that's something I would look for, if I were interviewing advisors.
Yeah, I think that's really good advice to have someone in your corner that's empathetic and understands your situation. All right. Well, this really brings us to the end of our advice, but really brings us to what are we going to be watching next week? And every week ends up being a lot of firecrackers and a lot of show fireworks per se. And next week, I'm sure will not disappoint with the 4th of July coming up next week. But there are a number of big stories that we'll be watching. Peter, June unemployment is coming out next week. What are we expecting?
So it's a really important number because the big question of whether, or I should say when, because the Fed will cut rates this year, but when can be decided by this payroll number or maybe the one after. Because I think the Fed is going to be very sensitive to any rise in the unemployment rate and focus more on that than inflation if it were to rise. So that could pull forward the potential rate cut to July from September, notwithstanding what Jay Powell said, if this number is weak. So it's going to be a big focus. You mentioned obviously the holiday, also the day before it's a half day. So really only have 3.5 trading days this coming week. But the economic data is certainly going to be in focus with very little earnings to note.
Yeah, I think another big thing when we think about President Trump and The Apprentice, right? He's already saying he's got 3 or 4 candidates to replace the Fed chair. So he's practicing his "you're fired" statement. He's going to announce them, his pick soon. Among them, Peter, you mentioned the federal governors, the Secretary of Treasury, Scott Bessent, maybe World Bank President David Malpass. Andy, would love your thoughts here. How does this impact the individual consumer that's investing and has a financial plan?
I think it'll be more theater than anything. I mean, what Trump's trying to do is put pressure on Powell. Like Peter said before, this is going to be the sweepstakes of who will go along and lower, rates as soon as possible. And so I think he's trying to put pressure on Powell by putting these people forward who are saying that they would lower rates. But I think it's more theater. I'm not sure whether the more pressure Trump puts on Powell, I'm not sure if that really helps. Because I think, Powell knows he's done. I really believe, whether he's right or not, history will have to tell us. But I do believe that he's trying to do the best he can. And I think he's trying to do what he thinks is best, for the economic system. And I think he kind of pushes back a bit. So I think it'll be interesting theater. I don't know whether it's going to have that much impact on the markets.
And Peter, any thoughts from you?
Well, I think it's becoming clear that whoever does get that job is going to have to lean towards easier money in order to satisfy their boss. So that's, I think, one thing that the market's beginning to sort of sniff out, that while Powell still has, a decent amount of time before he leaves, whoever replaces them is going to lean towards rate cuts, which has the potential of weakening the dollar. And we'll have to watch how the long end of the yield curve responds to that, because long end investors in the bond market don't want inflation. They don't want easy money. They want tight money because that preserves their purchasing power. So that sort of tug of war between the short end that the Fed impacts and the long end where the market drives is going to be a very interesting interplay.
Yeah, that's right. And, July 9th, the tariff deadline is fast approaching. Not next week, but the following week. But it's something I'd love our viewers to have insights on. Could there be some deals that they make next week? Or is there anything that you're looking for, Andy, to help translate for your clients?
Well, I'm going to defer that to Peter.
Okay, fair enough.
I think that the July 9th date is all of a sudden now a soft date. I think it was Karen Levitt, the press secretary for the White House, who alluded to that today. So they're not going to be stuck to it because there's still a lot of big trade deals that need to be negotiated, particularly with the EU, with Japan, with India, that may not get done by July 9th. So I think that's more of a soft date now rather than, okay, this is the date. And then on July 10th, those reciprocal tariff rates are going to kick in. I think there's going to be a lot of room around that date.
Yeah, so we don't necessarily need to see specific actions by the 9th, but at least they'll be directional for us. So that's very helpful, Peter. And Andy, I know you don't want to deflect this one because I'm sure you have some good plans set up for the 4th of July. Anything you've got going on with your family?
We'll be at the beach, with the kids. So we're looking forward to taking a little bit of time off. Yeah. And being at our favorite place.
Well, Jersey Shore is a great place to be, but be careful of those umbrellas, as we've talked
Yes.
about.
Yes.
There's some headlines happening.
Yeah. We'll keep our
Eh,
eyes open.
That's right. Peter, what do you've got planned for the 4th of July?
I will be in Italy eating and drinking.
Oh, fantastic. Well, my family and I, we have an e-foil. Have you guys ever heard of an e-foil where you stand on it and it goes across the water? It looks like an electric surfboard. Have you ever seen
Oh,
one of those?
Yes, I
yeah.
have.
And so Scott and I bought that for our kids, and we're all pretty decent at it now. So we're going to go up to Lake Shasta and enjoy some e-foiling time in the sun. So it should be a great weekend.
That
And so
sounds
that
great.
really ends our show here today. And I just want to thank our viewers for joining us today. Hopefully, this information was helpful, will help us prepare for next week, which there'll be a lot of important decisions being made. I want to encourage you again to go on to wealthion.com for a free portfolio review to get the helpful guidance that both Peter and Andy provide for us today. Please subscribe to the show, send us your feedback, send us your questions, and most importantly, have a great holiday week next week. Thank you.